Hi, Theo traders. This is Gianni DePoce, and today is the 16th of January, 2024. And I want to take some time today to review some really important charts. Stocks starting off the short and trading week a bit on the defensive. Meanwhile, the dollar is catching a nice bid and pushing both the yen and the euro down to multi-week lows. So if you recall in last week's video, I pointed out that stocks were going to have to figure out a way to rally in conjunction with the dollar if they want to continue their bull trend. And we're seeing some of that struggle unfold this week as the dollar stages an impressive comeback here on Tuesday. Nice bid against USD JPY here on the screen, and we're pressing up into key technical resistance, which is in the 146 to 148 area. And unless we can get back above there, I think there are still some downside risks in USD JPY. But if we do get back above there, then I think we could see some of the upside momentum that we saw in this currency pair really start to come back into the picture in 2024. Now, if we go ahead and take a look at the euro, we can see that we saw a decisive break down lower from that multi-week consolidation of the losses. As a rule, consolidation of losses are bearish price action. Now, we did drop to the lowest level since mid-December today, and I'm a little more bearish on the euro than I am on the yen against the dollar. If you look at the cross between the euro and the yen, the euro is actually appreciating against the yen right now, but I can't rule out a scenario where we could be back at par against the euro for the dollar in the next few months if this current price action continues. So we did seemingly complete a significantly lower high with respect to the longer term trend in the euro at the end of December. And as I look at this chart and factor in some other important cycles in this market, I can't rule out that we've already seen the high of the year in the euro. In other words, the euro could spend most of this year losing value against the dollar, and it could be significantly lower by the end of this year than where it began. Now, if we go ahead and take a look at stocks, we see the S&P 500 down about 0.6% or 2/3, 0.66% here. It's kind of still range bound here. It's not really the end of the world. There is still some constructive price action under the tape. So if you go ahead and take a look at the Nasdaq, you'll see that the Nasdaq is down slightly today, down less than the S&P. That's usually a good sign. But what I'm most intrigued by is the strength in semiconductors. The Van Eck Semiconductor ETF did just hit a new all-time high today, and that's not really the type of price action you would see if stocks were about to roll over. Now, if we look at the Philadelphia Semiconductor Index, on the contrary, it looks like we could be forming a secondary lower high. So it's not clear-cut in semiconductors, but the fact that we're up today amidst this rather turbulent mixed tape does give bulls some hope. Now, a lot of that strength is being driven by stocks like Advanced Micro Devices that we've had on the books for a couple of months now, approaching our upside target of 170. I'd like to see that reached in the next couple of sessions so we can reduce our exposure on that. We also are seeing a nice bid in semiconductor stocks like Rambus, which hit a new all-time high today. And this is one that we've had on the books for quite some time. And then last and certainly not least in the semiconductor space, we do like Marvell Technology. Did pick up along on this one not long ago, but it's still consolidating within the price patterns. Good risk-reward profile in my view. And this one is really key in the 5G space. And, down a little bit with the market today. But again, I think the strength that we're seeing in the semiconductor space, it would be irresponsible to ignore that despite the choppy nature of the price action and the indices right now. So another sector that's showing quite a bit of life is uranium. So URA ETF hitting a new multi-year high here. We did call out a long position on Uranium Energy Corporation last week. This stock popped quite a bit in just a couple of days. We do have an upside target at 9.2 on this one. So, a couple other stocks on our radar in that space. Obviously, CCJ, Cameco, we're giving back some of those gains today, but, could need a little more time digesting that impressive breakout from Friday over the next couple of sessions before resuming its bull trend. And then there's other stocks like Centrus Energy that are worth paying attention to as well. But I think, one of the things we need to keep in mind is what's going on in the bond market. So we're seeing duration sell off or lead to the downside in bonds. And that does suggest some caution, especially because we've seen such a tight correlation between stocks and bonds coming off those October lows. Now, the thing to understand here as it pertains to bonds is that we're seeing long-term bonds lead the sell-off to the downside. So that means that long-term interest rates are rising faster than, short-term interest rates. So the 30-year interest rate is rising faster than the 10-year interest rate, rising faster than the 5-year interest rate, rising faster than the 2-year interest rate. Once the Fed starts cutting this year, if we see this sell-off in bonds continue, it's going to lead to a rapid steepening of the yield curve. And a lot of times when you get that rapid steepening, it usually means there's some sort of economic slowdown or some sort of financial event taking place. So, while many are cheering the prospects of more liquidity in the financial marketplace, there is something somewhat sinister brewing under the surface right now that I think we need to be cognizant of its presence. We don't know what it is. I'm not really concerned what it is, but the intermarket movements that we're seeing right now suggest that something is off. So don't hesitate to take profits in this environment. I have some cash on hand. I'm not forcing any long positions. We are no longer in that easy money environment that we were in really since October to December. So far this year, there's been a few nice, setups and trades, but again, just to reiterate, we are no longer in that easy money environment that we were in even just a month ago. So that being said, I think it's important to calibrate our risk reward expectations appropriately. I do like what's going on in the healthcare sector still. We've been talking about this sector and how you had stocks like Amgen hit a new all-time high. Now there is a defensive element to healthcare that needs to be recognized as well. Yes, there is some innovation in the space, with biotech and whatnot, but healthcare is one of those things when you understand that consumption represents 70% of US GDP. It's one of the few things, or one of the last things rather, that consumers will cut back on when it comes to spending money. So when you start to see healthcare outperform and it started to come back to life this year, it does suggest some caution. But again, it's not as risk off of a signal as seeing utilities or consumer staples outperform, which we're not seeing really quite yet. There was 1 week, like 2 weeks ago, where consumer staples outperformed, but that wasn't the case last week. And overall, you have stocks like Nvidia hitting a new all-time high today. So again, bullish factors, strength in the semiconductors, uranium's a bright spot. The bearish factors right now, the dollar strength, stocks still can't seem to figure out how to rally with the dollar. And what's going on in the interest rate space, bonds selling off. We know that we've had a tight correlation between stocks and bonds. So, if you put those factors together, it's kind of like two bullish ones, two bearish ones. Obviously, uranium's not a big sector in the market, but, some of the communication sectors are looking pretty good too. So it's not by any means all doom and gloom right now, but again, to reiterate this one last time, we are no longer in that easy money environment, and various cycles are pointing to an imminent pullback of some sort. To what degree? I don't think the big correction is coming yet, but I do think we will see a big correction at some point this year in the range of 10 to 20%, and probably will catch a lot of people off guard, but hopefully not with us here at TheoTRADE, because we're already talking about it now. So that's all I had to share with you for this week. Gianni DePoce signing off. We'll see you next time. Thank you.